Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Facing the Fed's FTX, co-founder Sam Bankman-Fried arrives in New York to face criminal charges as two of his associates plead guilty to fraud in connection with the collapsed crypto exchange. Unwavering support, President Biden doubles down on backing Ukraine for as long as it takes as President Zelensky meets with Washington lawmakers in his first trip abroad since the Russian invasion. Plus, Germany's finance minister says Berlin is veering away from over-reliance on Russian energy and outlines his vision for strong transatlantic ties in a Bloomberg exclusive. So let's get onto the markets. It does seem like we're finishing, we're starting on Thursday. I'm getting a bit ahead of myself, but I know there's a number of market participants that are off for the rest of the year. And so S&P futures for the moment gaining some 0.2%. If we were to look at European stocks, it's also similar again across the board. Now, there's nothing fundamentally that's changed. Maybe a bit of positioning, also volumes quite thin because we're nearing December 25th. Global stocks gaining after U.S. shares, though, rose on improved consumer confidence and better than expected earnings. Now, as the fallout from the Bank of Japan surprise policy change begins to ebb, Treasury yields sliding a touch, as well as the Japanese 10-year yield. Meanwhile, the yen has actually resumed its rally. Now, we're joined by Salman Ahmed. He is Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, I'm excited speaking to you because we look forward into 2023, and I guess if 2022 was the year where inflation surprised and, of course, central banks were humbled, what are you worried about most in 2023 that we could get wrong?
Good morning, Francine. So basically, 2023 for us is turning to be a year of the growth damage, i.e., as you rightly pointed out, inflation increased so significantly. And as central banks changed their policy stances, firstly signaling tightening and then actually delivering tightening, and we saw the Bank of Japan being the latest one to do that. We are now waiting for the price we have to pay for this inflation to turn. And that's going to be in terms of growth, in terms of the damage to the labor market. And that's what we are focused on, that how much of this tightening starts to negatively affect the economies, the various economies. And then, of course, for equity markets, it's the impact on earning profile. And for bond market, it's the combination of growth and inflation mix, which will potentially change in 2023.
So, Salman, first of all, give me a sense of where you think, are there any parts of equity markets that are actually pricing a recession, or are they still trying to look through that?
So back in October, our assessment was that equity markets overall was starting to price in a meaningful probability of an average recession. That has changed quite significantly since then. Of course, the CPI release was an important factor, but also the thinking behind that a soft landing can take place. So we are not in that camp, even though a lot of commentators and analysts are saying that recession is their base case, but that's not what you see in equity markets, especially if you look at cyclicals versus defensives. And we're thinking that earning profiles will start to come under more pressure as real data starts getting hit, and that's why we are a bit more cautious and defensive going into 2023.
So what does that mean, Salman? How do you play that tactically?
So tactically, we are underweight equities. We are not overweight cash. We have started buying bonds recently as yields went up, as we thought that this phase of macro cycle will transition from focus on just on inflation and central bank tightening to the growth damage. So we are now underweight equities and we are overweight bonds and especially IG credit as well, as we move towards 2023, which was not our main stance during 2022.
I know one of your key macro themes, which you were kind of alluding to, was navigating the poly crisis. Is there a chance, and I know you believe in a recession, but is there a chance that actually inflation takes everyone by surprise and comes down quicker than we thought it would?
We are looking at those different factors, Francine, and supply side factors will play a big role there. But the point is that we're making is that the supply side relaxations are already most of them done. So we have seen good inflation coming down, and it's now the problem is on non-housing core inflation, as Chair Powell focuses on it, and it's a very demand sensitive component. and that will need some damage to growth. And then the tightening you have seen this year, and you compare it to all the recessions we have seen since 1948, it's a very significant tightening. And it will have implications. And that's why we are cautious, and we are skeptical that a soft landing can take place just because supply side issues resolve themselves, and we have a soft landing as a result of that.
Are we misunderstanding what a China transition to a reopening economy means for the rest of the world?
The China reopening will be important for China. It has been in a very different economic cycle, as we know, because of zero COVID policy and, of course, the other policy changes which took place. For China itself, it's going to be a very important, significant factor, and it may spill over to the rest of the world through the commodities channel as demand comes through. But we have not seen Chinese pressures or Chinese growth pressures affect the global economy in 2022. I mean, U.S. economy was very strong. European economy was initially facing this reopening rebound. So these economic cycles have diverged quite significantly. And yes, it will probably help from a global perspective, but the domestic tightening is so strong that we think that will be the dominant factor rather than the China reopening.
But Salman, I mean, on the China reopen, does it really push? We're in a scarcity environment. I know we have supply chain issues. Does it push energy prices to almost breaking point?
So the rule of thumb is around a million barrel of oil demand, extra oil demand pushes oil prices by around $20 to $25. Of course, you can have volatility around it, and the assessments which have been coming through is that China's ZCP policy has been destroying demand up to a million barrels per day. So that's an important source of demand which will potentially come through, and energy will be the factor. But we do think that the core inflation and the core domestic side of the economies will be under pressure, which will be the key factor rather than this headline inflation boost, which may come through as China opens up temporarily, boosting the demand for oil.
We also had, it's been a big week actually in the markets. I know it's quite quiet, but then we had that Governor Kuroda shocker. How strategically do you play Japan or yen?
So we have been flagging this risk for global markets for a while now, and no matter what the narrative which is coming through is that this is adjustment to the policy, it is a step towards an exit. And you can see that in the JGB yields, they are they have risen, they have not fallen despite the fact that the corridor was widened. And the firepower now available to BOJ is bigger. The fact is that that market is being dominated, and it will continue to remain dominated by BOJ. And it is an internally inconsistent policy. So we are thinking that this is the first step towards exit, and then dollar looks vulnerable here as Fed maintains its hawkishness, and other central banks like ECB and BOJ catch up, and those interest rate differentials will move against the.
Salman, I haven't asked you something that actually worries me, and I hear it more and more from market participants, and that's liquidity. Is there a worry that 2023 markets come to a halt, certainly in some parts, in some asset classes, because of a lack of liquidity?
So, Francine, as you know, all the key central banks which were providing liquidity until 18 months ago or 15 months ago are pulling it back, and the Bank of Japan is the latest one. So we do worry from a top-down perspective that liquidity is being taken out of the system, and that's why we have to reprice some of those risk premiums. But at the micro level, we know that the treasury market liquidity is under stress. And you can have big moves on small data releases, and then of course the shadow banking sector itself may suffer a more wider liquidity shock. So that's something for sure to look at as we move into 2023.
But on the shadow banking, Salman, are you impressed by the fact that, given all of the crazy news, frankly, that we had in 2022, markets still held it together? Because usually in a big, there's so much leverage out there that in this kind of aggressive hiking cycle that frankly took a lot by surprise, we could have had some really ugly market events. Or are they just delayed into next year?
So, we've been looking at the refunding profiles of the corporate sector, which has levered, to your point, quite significantly, especially during pandemic. The good news is that a lot of the refinancing flows we pick up are from 2024 onwards. And 2023, especially in high yield, we don't see a big refinancing wall coming through. That gives time to the Fed, and that gives time to the system to adjust to these higher rates. But these rates cannot stay at these very high levels for much long, because these are like a 5% terminal rate for the US is a very high rate. So as we move towards 2024, we do think that those problems may start to become key focus areas, especially if the Fed doesn't relent and starts cutting rates by middle of next year.
Salman, thank you so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up, our half-hour UK special, 9:30 a.m. We'll be looking, of course, into the state of the economy, recent data highlighting a deepening recession, and how Brexit fed into that. The Chief Executive of upmarket British brand, Fortnum Mason, will join us to discuss all of this, as well as share his growth strategy outside of Europe. Don't miss that interview. It's exclusive, and it's at 9:30 a.m. UK time. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Sam Bankman-Fried has landed in the U.S. to face a litany of criminal charges tied to his role in the collapse of crypto exchange FTX. This comes as the SEC charges Alameda's Caroline Ellison and FTX co-founder Gary Wang with fraud. Now, joining us is Bloomberg's crypto senior editor, Anna Herrera. I mean, Anna, there's all sorts of intrigues trying to figure out also I think there are ex-girlfriends involved. What's the latest on Bankman-Fried's journey?
So he's in the US now, and the US district attorney was saying they're trying to get him in front of a judge as soon as possible. And obviously, as you said, meanwhile, as he was en route to the US, we discovered that two of his top lieutenants, Caroline Ellison and Gary Wang, were collaborating with US authorities, and they pled guilty. So the SEC and the SCFTC have amended their lawsuits to include them, and we've had more details about what was going on behind the scenes, which included Gary Wang, including lines of code that would hide how much Alameda was borrowing from FTX, and also the fact that most notably when Terra collapsed in May, and that caused a trigger of margin calls, Alameda was running out of money, and they took funds from FTX, so customer funds. So it is quite, a big and a long list, and a long list of charges and a long lawsuit.
Yeah, it certainly is. What are the details, actually, that we know of the plea agreements from the FTX associates?
We don't really know much of the details of the plea agreements, but we know that obviously when you do plead guilty and you do collaborate with authorities, the prosecutors tend to ask or will ask if you collaborate for a lower sentence. So, and also that, I guess that also means that, for other executives that were at FTX, anyone else who could have information, the district attorney said that, they should come forward now, that their patience is not unlimited. So we'll wait to see if more names pop up.
So, Anna, what does it mean for Bitcoin going forward? It's currently around $1,700. I mean, is there more fallout than what we've had so far?
We could see more fallout. We could see more people or more companies that were somehow connected to FTX and Alameda, either they were counterparties or not, that might get hit too. In the immediate collapse of FTX, we saw a company called, another company go bankrupt, another lender, BlockFi, because they had been rescued by FTX, and obviously FTX needed rescuing too. But we could see more dominoes fall. It depends whether it will. Obviously, the impact on Bitcoin will depend on the size of that firm, I guess.
Anna, thank you so much. Bloomberg's crypto senior editor there, Anna Herrera. Now, coming up, we hear exclusively from a former Japanese Vice Minister of Finance for International Affairs, commonly known as Mr. Yen, after the BOJ's shock move this week. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Esukue Sakakibara says the Bank of Japan may surprise markets again by tightening monetary policy as soon as next month. The central bank surprised investors this week by raising its cap on 10-year bond yields to 0.5% from 0.25%. Sakakibara, also known as Mr. Yen, for his ability to influence the currency during his time as Japan's vice finance minister from 1997-1999. Now, he spoke exclusively with Bloomberg's Kathleen Hayes about where he thinks the yen is headed.
It is now 135 or something, right? 32 or something. And it will probably slowly, appreciate toward 120.
And what's going to drive it beyond there? Or do you think that's the level we're going to see the yen holding at for some time?
Yeah, I think it will hold around 120 for some time.
Okay. In terms of the next meeting in January, is because the BOJ, because Kuroda has made this move, widening the band of yield curve control, is it possible that there could be another shift in policy on the table in January?
It's possible, but I don't see any concrete move at this moment. But Kuroda may move at the next meeting.
And if he did, what would he do? Would he move on the negative rate? Would he widen the YCC band again?
Well, maybe he would widen the band. But, it's very difficult to predict that at this moment.
So it's a pretty basic question. Is it clear that policy normalization has already begun?
Yeah, I think so. Kuroda was quite aware of that. And, he has sort of expediting the policy normalization a little earlier.
Well, Japan's former vice finance minister, Mr. Sakakibara, there with his views on the yen and BOJ policy. Now, let's also get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ukraine's President Volodymyr Zelensky has addressed the U.S. Congress, telling lawmakers his country is alive and kicking despite almost 11 months of war. In Zelensky's first overseas trip since the start of the war, he thanked Americans for their support while renewing pleas for more advanced tanks and also fighter planes. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning customers away months after the city of 25 million endured a brutal lockdown to stop the virus spreading. COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed and public transport usage is also plummeting. More than 3/4 of UK businesses surveyed say the government's Brexit deal has not helped them increase sales or even expand. According to the British Chambers of Commerce, Brexit has damaged the ability of companies to compete in the EU, with businesses, quote, banging their heads against a brick wall. The researchers published on the second anniversary of the agreement between London and Brussels. And H&M has halted sales of its Justin Bieber collection after the singer accused the company of selling clothes depicting him without his consent. The Swedish retailer says it followed all proper approval procedures, but is pulling the goods out of respect. In other Bieber news today, the singer is said to be near a deal to sell his music rights to an investment entity backed by Blackstone. Bloomberg understands Bieber's stake could fetch as much as $200 million. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Lovely Bieber news there, Francine.
Yeah, that's what I call Bieber fever. Thank you so much, Leanne Gerrans. Now, let's check in on some of the stocks on the move. First of all, we start with STMicroelectronics. Now, this is after Micron's earnings actually missed estimates. So let's see exactly how they're moving today. Now, the other story on STMicro is that Citadel did boost its short position in STMicro to 0.61%. I don't think it's having a huge, look, STMicro is down 0.4%. In a market where overall equities are up, it's not great, but it's also not a huge move. The other thing we're watching out for is, of course, Prosus. Just a couple of days ago, I think Prosus had the Tencent funded buyback unlocked some $15 billion in value. Today, it basically said it continued to buy back some of the Tencent shares, bought back some $266 million of shares in the week December 12th to December 16th. Prosus gaining 0.8%. And finally, Stellantis, this is on the back of demand normalizing for a lot of the cars out there because the supply chain is also normalizing. Stellantis down 0.5%. Coming up on Bloomberg UK this week, we hear from the chief executive of London's iconic department store, that's Fortnum Mason, on how the luxury retailer is doing this festive season. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to Bloomberg UK, a news show with a special focus on the biggest challenges facing the British government, the British economy, financial services, and the markets. I'm Francine Lacqua here in London. Now, on the show this week, with just days until Christmas, the UK is grappling with its worst labour disruption for 30 years. We'll look at how businesses are coping with transport strikes during the crucial festive period. Also on the programme, how is the new winter of discontent affecting luxury retail at Christmas? Well, we're joined by the chief executive of London's iconic department store, Fortnum and Mason. Plus, with the UK set to enter a recession, we recap a turbulent year in British politics and finance. But first, we begin with the story that, of course, is dominating front pages in the UK today. Public service workers continue to strike over wages as the cost of living crisis takes bite. It's impacting everything from healthcare to public transport. And it couldn't come at a worse time for hospitality and retailers already struggling with the economic downturn and spiraling prices. There's also no festive cheer from the CBI, warning of a deeper recession in the latest quarter than previously thought. So let's discuss all of this with our UK retail reporter, Katie Linsell, and Bloomberg UK's John Stepek. So thank you both for joining us. John, I mean, when you called also that house prices could fall some 30%, I have to say it sent shockwaves, not only in markets, but all the way to like Brussels. So overall, we've had a really tough year in the UK. We're having an even tougher December. Does it get better or does it get worse?
Well, you see, this is the tricky thing for next year. I mean, there are elements for next year, trying to be a bit optimistic about it, that could actually get better. So the inflation rate should come down. Yeah. Petrol prices are coming down. Beyond that, I'm kind of struggling a little bit.
He's trying so hard to be optimistic. John, come on, you can do it.
Well, the problem is, I mean, I suppose, so interest rates, mortgage rates have come down a little bit since the peak in October. But you're still looking at kind of like 1.8 million people coming off fixed rate mortgages next year. That means that, you know, the price that they're paying is going to go up. So that's an additive onto the cost of living squeeze. We have, you know, there is a kind of wider issue as well in terms of the indebtedness of the kind of UK government and how they're going to deal with the strikes and what that means for the public finances. So there's another issue there to be concerned about.
Yeah, and John, I mean, this is, you know, no laughing matter because a lot of people are also struggling. I guess even in your piece, you say mortgage holders are actually maybe better off than they were in 2008. And then I want to talk about retail because, Katie, I know a lot of people are struggling because they can't, or certainly central London bookings like pubs and also retailers aren't getting that footfall because of the strikes. But overall, consumers are still spending.
Well, yes, consumers are still spending for now. I think for sure when we look forward to early next year, it's going to get harder and harder when we have sort of credit bills coming through, credit card bills, and then also looking at mortgage rates rising for many consumers, and that's going to be much tougher. But yeah, the strikes couldn't have come at a worse time for retail and for hospitality. Bookings down, footfall down, I think it was around 10% at one stage last week. And that's down on the period before when we had Omicron last Christmas that put off many consumers going into retail and going into pubs and restaurants. So yeah, it's a tough time.
So are people worrying about the cost of living now, or are they saying, look, I haven't really had a good Christmas with my family for the last 3 years, I'm going to spend and then tighten the belt in January?
I think it depends on which consumer you speak to. For sure, you know, we're not all impacted equally by this cost of living crisis, and there are those who are very wealthy and who are still spending big time, and also who are saying, you know, Christmas is really important to me. I really want to be able to gift to all my loved ones and have a fantastic time. There are others who are saying, look, let's buy each other the essentials this year. or let's actually cut back from buying each other gifts within our families and really focus on putting lovely food on the table. So it really depends across the population, I think.
So, John, if you break it down, and we know that the UK is very reliant on house prices, and we could see, and you went through the metrics, and actually I urge everyone to go and look at John's newsletter, because it beautifully, lays out the case for a possible 30% a drop in house prices. But if the labour market holds, will we be okay?
Well, I think the labour market holding is the main thing. Now, I still think house prices are going to fall, but I don't think that's necessarily a bad thing in and of itself. Because, about a third of people have mortgages, a third of people own their houses outright, and a third rent. No. At the moment, we have a massive affordability problem in the UK. So house prices coming down in and of itself is not necessarily a bad thing. In terms of consumer spending, in my experience, people tend to spend as long as they have money and as long as they have jobs. The main issue here is definitely employment. I think whenever we come to the kind of January reporting season, it'll be really interesting to see how the retailers kind of come out then. But the main thing to watch out for is, are companies going to be cutting back, or is the labour market still going to be fairly tight next year?
But the labour market is so tight.
Yeah, and
what kind of recession would we have to see for the labor, for unemployment to go significantly up from here?
Well, it would have to be pretty drastic, you would think. But the other reason that the labour market is tight is because we've got a lot of people in long-term sick. We've got a lot of people who have retired and stepped out of the market. We actually have a lot of students as well. So one of the tricky things at the moment is it's really hard to unpack how much of this is a hangover from COVID. I don't think we appreciate how much the pandemic is still basically mucking up the figures. So it's very hard to get a lot of clarity on what might happen going forward.
Yeah, that's the point of central banks and saying, look, it was muddled, and this is why we got the temporary inflation call very wrong. Katie, how are people spending differently? So I know you were saying, a lot of buyers are trying to trade down, but also go into things that are energy efficient, like air fryers, and I think energy efficient, what you were saying, like dryers.
Yeah, absolutely. So we saw Currys report, I think it was last week, and they were saying that they are seeing consumers sort of try to trade up to more energy efficient items. So that is air fryers that have done really well. It is tumble dryers and washing machines that are more energy efficient, because people, they're not maybe as worried about the upfront spend as they're worried about their energy bills over time. So they're really prioritising in that way. We've talked a bit before about electric blankets, other ways of trying to keep warm when bills are so high on our energy costs.
So are people overall, could we see them buying less, or just, buying as much but cheaper?
When it comes to food shops, we've seen people try and put fewer items in their baskets, try and stretch meals further across a family. We've heard of examples of people having to skip meals within the family. At Tesco's, for example, earlier this year, shoppers were saying, can you stop at £40? Can you stop at a certain spend, because I can't go beyond?
Yeah, and if you look at some of the inflation figures, we're looking at the price of egg milk. In certain cases, it's like up 15, 20%. Are we going to see peak inflation in 2023?
You would hope so. Apart from anything else, arithmetically, it's kind of got to peak. We probably saw it just there, actually, back in November. Energy prices, this is the other thing that comes down to how much of this cost of living squeeze is going to continue. Yeah. If energy prices come back and food prices stop rising, then you might actually find that next year we get real wages increasing. And that would be really positive. That would be a kind of upside surprise. But again, that all boils down to how tight the labour market remains. The good thing about this the problem that employers have had with hiring over the past couple of years means that even if they take a hit, they're much more likely to try and hoard labour in the coming year, because it was so hard to get the workers in the first place.
John, how much of this has to do with Brexit? So we have, the British Chamber of Commerce saying, first of all, UK businesses are suffering because of exports. And then we had also this think tank yesterday saying it's shaving off 5.5%, I think, of GDP growth. And that's, of course, also, importing inflation. And that's because we have the strikes. Yeah,
look, I'll be honest with you. I don't see Brexit as being a massive issue economically. It's certainly not the major factor that's driving all this. One of the problems with think tank reports is that obviously a lot of them have a kind of political bias one way or the other. And it's just very hard to unwrap all this stuff. If you're telling me that you can seriously split out the impact of Brexit from a global pandemic in which we actually shut down the entire economy, then I'm sorry, I'm going to struggle to believe you. You know, the inflation came as a surprise to the vast majority of kind of economists and analysts around the world. So I don't believe that you can split the difference with Brexit down to 0.5%.
All right, really interesting. Thank you both for joining us. Our UK retail reporter there, Katie Lindsell, and Bloomberg's John Stepeg stays with us. Also coming up on Bloomberg UK this week, we hear from the chief executive of London's iconic department store, Fortnum Mason, on how the luxury retailer is doing this festive period. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Brexit has damaged the ability of UK companies to compete in the EU. That's the finding of a survey from the British Chamber of Commerce. 77% of firms said the Brexit deal struck 2 years ago was not helping them increase sales or expand their businesses. Now, British department store Fortnum Mason has also seen its European sales hit by Brexit disruptions. The upmarket brand, which is best known for inventing the Scotch egg, as well as special blends of teas, biscuits and Christmas hampers, is now looking beyond the UK and the European Union for its future growth. Well, we are delighted to bring some festive cheer, and we're joined by Tom Athron. He's the Chief Executive Officer of Fortnum and Mason. Tom, thank you for joining us. I mean, it is really Christmas when you look at a Fortnum background. What has been the most surprising thing for you? So we're going through a huge cost of living crisis in the UK. There are strikes in central London. Are people still shopping more than you thought they would?
So, morning, Francine. It's lovely to be here. It is, without doubt, it's a tough trading environment. You know, with the war in Ukraine, inflation running at more than 10%, the backdrop of strikes, as you've mentioned. It's a tough environment. Businesses and consumers don't like uncertainty, particularly at this time of year. I think what surprised me most about Christmas this year is actually the return of footfall into our shops that we've seen. Against that backdrop, I think I've been really surprised about that. And I think to a certain extent what customers are looking for is that sort of moment of joy. I think they've rediscovered the enjoyment of shopping in person. And I think Fortnum & Mason really lends itself to that. You can't help but walk into this shop and for a smile to creep across your face. And I hope you can see in the background that, you know, when we open our doors, our customers come into the shop like a bullet out of a gun. So that's really good to see. I think the other thing that's probably surprised me is the strength of our international trade. I suspect a lot of that is down to the weakness of sterling, or the relative weakness of sterling compared to last year. Don't forget, this time last year we were up against some really a really tough background. We were still emerging from COVID. We had the latest wave, which I think was putting people off going out shopping and eating at restaurants. And I think that this year we're sort of through that. Our restaurants are full. We have a lot of events going on every night, so it's the return of Christmas parties. In many ways, it's the sort of it's the revival of Christmas that we saw pre-pandemic back in 2018, 2019.
And Tom, we're just getting, of course, breaking news from China, which is huge news, and a lot of the markets will kind of listen to this and take pause. China is to cut its quarantine for overseas travelers from next month. That would probably impact, of course, also your new store in Hong Kong International Airport for global travel, and of course the resumption of back to business in this post-COVID world. That's probably positive business. I can't remember. I remember seeing that I think you make about 60% of your revenue in this kind of festive season. How much will that change, or how much have you tried to change that and also be less reliant on the UK because of weaker pound and because of the strikes?
Well, it's interesting. I think historically we are a very Christmas-focused business. I think that's absolutely right. One of our opportunities is to think about how we can become more relevant to more people more often. And I think that there's a big opportunity in the UK for that. Our online business is now anywhere between 30 and 40% of our business. And if I go back to a world pre-pandemic, that was more like 5 or 10%. And I think what we're doing is using our online business as a way of attracting a whole bunch of new UK customers, actually, to a business. To a business which really has one flagship shop and a number of satellite shops in London. So it's opening up the brands to parts of the UK that don't necessarily have access to our business every day. So I think our online business is a big opportunity for growth. Before I even get to thinking about growth overseas, it's wonderful to see those restrictions beginning to be lifted in Hong Kong. We have a shop and a restaurant in Hong Kong, in Kowloon, which historically has served Chinese tourists from over the border. As you can imagine, that's been very quiet for the last couple of years, but I'm hoping that over the next few years, we see a real resurgence in that. And I think a demonstration of our commitment to that region is, as you say, the opening of our shop at Hong Kong Airport last month. So I'm expecting big things from our Hong Kong team over the course of the next few years.
Yeah. So who's shopping in your stores at the moment in London? Is it a lot of people from the US? Is it tourists? Is it British consumers? And have they adapted the way they shop?
So they certainly have. I mean, I certainly think they've adapted the way they shop in relation to returning into shops, as I mentioned earlier. I think that we're also seeing a big international trade this year, probably certainly more so than we saw last year, and indeed pre-pandemic as well. And in particular, those customers are coming from the EU, where we're no longer able to ship directly to the EU, and from America as well. So we're delighted to welcome those international customers into the UK. And of course, they're buying across the range. Not only are they shopping in our shops, they're eating in our restaurants, they're coming for afternoon tea. I'm thrilled to say that our hospitality business is doing really well. And as I said, I think people are looking for a bit of togetherness this Christmas, and there's nothing that brings people together, certainly at this time of year, more than food.
What's your most sold out product? I mean, I'm here with John Stepek, who's probably going to tell me he goes to Fortnum Mason for Christmas tea every day. But is there one thing that actually just flies off the shelves that you can't get enough of, Tom?
I think probably the one thing this year, and again that's really surprised me, is that we've sold out completely of pickled Brussels sprouts. They were $9.95. They've all gone. There are still a few jars or a few bottles left of mince pie and marmalade liqueur, which is absolutely delicious. It's like a mince pie in a glass. It's really good, £35. So they're the two things I would that really jump out at me as being fantastic products this year. And actually, I mean, you mentioned the Scotch egg. We invented the Scotch egg in 1738. It's a really good example of the sort of innovation, actually, you can get from Fortnum Mason, which is, I think, really the home of extraordinary food and drink.
Tom, thank you so much. Sponsored by Fortnum Mason. I'm not sure about the pickled. I mean, we need to get that. I need to go online, take it in, have a think, and then get back to you. Tom Athron, they're the Chief Executive Officer of Fortnum and Mason. Coming up, what were the UK's biggest moments of 2022, apart from Scotch egg and pickle things? Well, we, of course, look through the list of the record-breaking year that we've had so far. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, from Queen Elizabeth's death to a scorching summer heat wave, it's been a record-breaking year for the UK. Here's Bloomberg's Irina Angel and Celia Bergen counting down to some of the country's biggest moments in 2022.
What a year for the UK. Record after record broken. And new ones being set. Students of the future, you're going to have loads to revise one day when it comes to 2022.
Well, we've actually lived through it.
So here's a quick recap of the last 12 months. Let's begin with the most somber moment, the passing of Queen Elizabeth II in September. 7 decades on the throne, Britain's longest-serving monarch, 15 prime ministers, and, of course, the queue.
From the longest reign to the shortest run, Liz Truss was Prime Minister for just 49 days. Still, she managed to sink gilt markets and send the pound to a historic low. Now, the government is cutting spending and raising taxes.
Next, prices. Everything going up, up, up and fast. Take an English breakfast.
Butter, £3.30, up from £2.60 last year. Eggs, £2.40 from 2. Bread, up 18%, let alone the gas to cook it.
Today, inflation is at a 40-year high. That's the worst since the first Indiana Jones film. Want more records? Well, how about record heat? In July, temperatures topped 40 degrees for the first time. Train tracks buckled, fires broke out across London, and all the while, England was experiencing its worst drought in years.
Let's not forget the reasons to cheer. The Lionesses won the Euros, the first English Cup in 56 years. They got to do it here, at Wembley, with 87,000 fans. The most for a UK women's game ever.
Climate, politics, royals, sport, nothing was spared this year. So what's in store for 2023?
If 2022 shown us anything, we'll just have to wait and see.
Bloomberg's Irina Angel and Celia Bergen there on the UK's big year. Now, we're joined again by Bloomberg UK's John Stepek. John, I mean, on the markets, it was also a crazy year. What was the most memorable day or week for you?
I mean, it had to be the gilts meltdown in September.
Was something else.
Yeah, that was one of the most striking moments I've seen since 2008, because the speed at which that unravelled was actually slightly scary. But also, what I found really interesting about that is that unpacking what actually happened is still quite tricky. Yeah. It's very easy to kind of point to the Truss government and Kwarteng, and that definitely was the match that kind of ignited the bonfire. But I think that whenever we look back on this, the fact that the defined benefit pension schemes were so heavily into these LDI, liability-driven investment funds, which again was the product of the low interest rate environment and also regulations. It'll be interesting to see how that eventually gets unpacked.
But John, so if you think about the markets, and this is something that I've been thinking quite a lot, it's pretty incredible that actually when you see how many companies were leveraged, parts of the market that were leveraged, that you can go from 0.5% interest rates to over 3 so quickly without it having a huge fallout.
Well, I think the most interesting thing there is that since 2008, and this is one kind of weird kind of benefit of the fact that the UK was sort of at the centre of that crash. Like, consumers have deleveraged to an extent, and corporates have deleveraged to an extent. I think the riskiest areas are probably within the kind of private assets law. Because a lot of money is kind of like basically vanished from the public markets and actually in a weird way from the banking system. And then some of this kind of leverage is going elsewhere. And there's probably a lot of privately owned assets out there that have got, a price tag that says one thing. It's actually probably a lot lower than it really is.
So maybe that's a story for 2023.
I think so.
John, thank you so much. John Stepek there from Bloomberg Wealth. You can read more, of course, from John in the Bloomberg UK newsletter, daily newsletter, Money Distilled. And be sure also to subscribe to Bloomberg's In the City podcast. That's out today. This is Bloomberg.
Against all odds and doom and gloom scenarios, Ukraine didn't fall. Ukraine is alive and kicking.
And the United States is committed to ensuring that the brave Ukrainian people can continue to defend their country against Russian aggression as long as it takes.
If they attack us with Iranian drones and our people will have to go to bomb shelters on Christmas Eve, Ukrainians will still sit down at the holiday table and cheer up each other. All of us, millions of Ukrainians, wish the same: victory. Only victory.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 5 a.m. in New York, 10 a.m. in London, 6 p.m. in Hong Kong. Our top stories today: unwavering support. President Biden pledges to back Ukraine for, quote, as long as it takes, as President Zelensky presses Congress for more tanks, planes, and cash to defend against Russia. Facing the Fed, Sam Bankman-Fried lands in New York to face criminal charges, while 2 of his top associates plead guilty to fraud in connection with the collapse of FTX. And Micron posts a lackluster revenue outlook for the current period, indicating the slump in demand for computer components will persist. Welcome to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York. Ed Ludlow with us out of London. Anna Edwards and Kaylee Lines are off today. Ed, we had quite a rally in risk assets yesterday. How are we set up from Asia and Europe for today?
Yeah, it's interesting. More energy in markets. We're limping a little towards the weekend amid low volumes, but we certainly saw momentum carry over from the US into Asia. The MSCI Asia Pacific Index closing up 1.2%, snapping 5 consecutive days of declines. A lot of that energy as well and focus on China. The Hang Seng, the real outperformer in the region, closing up 2.7%. It's all about reopening, really. You look at some of the outperformers within that index. It is those most tied to an economic reopening, retail, consumer-focused stocks, technology also doing well. The story of the week has been the BOJ in Japan, that surprise hawkish policy pivot earlier in the week, although they're not formally calling it that. You look at the 10-year Japanese bond, pulling the yield back towards 4% from that upper limit that was set Tuesday at 50 basis points, or at 0.4%. And then the yen, which kind of took a time out on Wednesday, now also continuing to strengthen somewhat against the US dollar. Europe, okay, there's some modest gains. We bring up the picture across continental and Western Europe, major indices largely in the green, but modest gains, very low volumes. We're very close to Christmas, as you know, Matt. And you look particularly at the stocks Europe 600, yeah, we're higher, a few tenths of 1%. There is a drag on the index, though, which is some of the European semiconductor names, in particular ASML, ASMI, or AMI, because, well, it's not just about Micron reducing headcount. It's not just about that tepid forecast on revenue, but they're also going to be cutting CapEx, which is hitting some of those names. And we're kind of chilling out, Matt, on the bond market. Yields kind of holding steady and not so much drama like we had on Tuesday when you, Matt, were still on vacation.
Yeah, well, I am still on vacation. I'm just taking a 2-day break from my trip. We're kind of chilling out in terms of futures today as well. Maybe that you could have guessed that, considering the big rally that we had yesterday, but no movement on S&P futures. The U.S. 10-year yield coming down about 2.5 basis points. Right now, 363.78 is the level on the 10-year, and NYMEX crude trading at about $80 a barrel, 79.44 for West Texas Intermediate. This commodity has been all over the place since the beginning of November, when we were up at $90, to a couple of weeks ago when we were down at 70. A lot of volatility here that cannot be said for Bitcoin. Maybe surprisingly enough, since the collapse on November 7th of FTX and the drop in crypto prices, we've really seen Bitcoin holding in a very steady range, around $16,000, occasionally breaking up above 17, but really holding around $16,853, which is where we see it right now. So that's what we see in terms of the market setup. Let's get to our top stories and really back to the geopolitical situation, because there was an historic moment in the U.S. Congress yesterday. Ukrainian President Volodymyr Zelensky giving a speech pressing Washington for tanks, for planes, along with tougher sanctions on Russia. He says support is, quote, an investment in global security.
From the United States to China, from Europe to Latin America, and from Africa to Australia, the world is too interconnected and interdependent to allow someone to stay aside and at the same time to feel safe when such a battle continues.
Let's bring in Bloomberg's Bruce Einhorn to tell us what the main takeaways were. And, you know, I guess, Bruce, my thought is there are some Republicans already pressing to curtail support for Ukraine, even as President Biden commits to supporting them as long as it takes. Did Zelensky's speech sway those Republicans yesterday?
I'm not sure that it's going to sway some of those Republicans. There's some Republicans who didn't show up to the speech. There were others who were there who would applaud tepidly or maybe look at their phones. They're the minority, to be sure. There was strong bipartisan support for the Ukrainian president. The speech was in many ways targeted at ordinary Americans, trying to shore up support for Ukraine. The big concern, of course, is that Republicans take over the House in just a few days, and some Republicans have said that the U.S. needs to rethink its support for Ukraine or at least scale back some of its support. Kevin McCarthy, the Republican leader, who's hoping to be Speaker, has talked about how the U.S. will not just be providing a blank check to Ukraine going forward. So in his speech, President Zelensky talked about how crucial U.S. support was for Ukraine. He also made a point of saying that U.S. support is not charity, that this is an investment in global security. He also talked about the need for more aid, more fighter jets, more tanks, other types of military assistance.
Bruce, President Zelensky, clearly the speech symbolic. He drew laughs at times. He drew support from those that were gathered. But he went for a reason, right? A list of physical things that he wanted and also, the sort of public support of the president. What sense did we get from President Biden about how much of that Zelensky is actually going to get?
Well, in the short term, it seems that he is going to get a lot of what he wants. President Biden announced during this visit that the U.S. will be providing another tranche of aid worth about $1.85 billion. That includes Patriot air defense systems. This is the first time that the U.S. is going to be giving the Patriots to Ukraine, in addition to lots of other weaponry. Congress is supposed to be voting sometime in the next few days on a big omnibus spending bill that would include $45 billion worth of additional aid to Ukraine. It's still unclear just whether that's going to pass or not. If it does, then that takes care of a lot of the concerns, at least for a while going into the new year. However, this is a war that's not going to be ending anytime soon, and Ukraine is going to need continued U.S. support. And so there is reason to be concerned about just where things would go going forward once Republicans control half of Congress.
Bruce, thanks very much for joining us. Bruce Einhorn there talking to us about the historic speech by Ukrainian President Zelensky to the U.S. Congress yesterday. Now let's get to crypto. Sam Bankman-Fried has landed in the U.S. to face a litany of criminal charges tied to his role in the collapse of FTX. This comes as two of his top associates, Caroline Ellison and Gary Wang, plead guilty to fraud and cooperate with prosecutors. Joining us now is Bloomberg's crypto senior editor, Ana Herrera. Ana, so this was a big bombshell overnight, right? We've got two of SBF's top lieutenants essentially cutting a plea deal or hoping for a bargain in exchange for giving evidence on him.
Yeah, so we know prosecutors have said they will recommend a lower sentence if Wang and Ellison collaborate. We also now know that the SEC and the CFTC have also amended sort of their lawsuits to include Wang and Ellison. And we have a little bit more detail about what was going on behind the scenes, which was essentially that when Terra collapsed, this is just part of everything that happened, but a big part was when Terra collapsed, Alameda sort of started getting margin calls from its lenders. It couldn't meet them. And so they had to borrow money and essentially take money from FTX customers.
Anna, I know there's a lot to go through in terms of the process. What was interesting in the Bloomberg reporting was some of the detail about the things that Ellison and Wang did themselves, which the SEC and others claim was at Sam Bankman-Fried's direction. What is it the prosecutors are going to have to do from here? What's the process?
I think what's interesting is they've also said that their patience isn't unlimited. And if you've worked with them before, or you were also an executive and you know things, now's the time to come forward. So it's interesting to also see if we'll have more information even still that will come out, if more executives that haven't been mentioned yet will come forward and collaborate with authorities, or if others will be charged. That remains one of the big things to be seen.
All right, Bloomberg's crypto senior editor, Ana Herrera, thanks for joining us. There's almost certainly going to be a top story, Matt, for the rest of this holiday period. Turning now, though, to Micron. 24 hours ago, I had a hunch that this would be a big story. The biggest US memory chip maker says it will cut headcount by about 10% in the coming year as it projects a wider than expected loss for the current quarter. Micron's loss comes amid a slump in demand for computer components. And joining us to discuss is Bloomberg's Joe Easton. The headline's kind of the cut in headcount, reduction in workforce, but there was quite a long list of worse than expected news, and CapEx, you look at some of the European market reaction, top of mind as well.
Yeah, exactly. So Micron really spoiling the festive spirit for the tech sector. But I think if you look at the root causes of it, it's really interesting. So I think the tech sector chips, specifically memory chips, have probably been oversupplied for around 18 months, really. But then you kind of had all these supply chain issues, which meant that the inventory wasn't able to be shipped. And that really artificially kept prices high. Then that supply chain disruption eased at the same time that we've seen demand coming off now, with companies predicting lower smartphone sales, lower computer sales, and a whole consumer downturn. And those have combined together and resulted in this really negative report from Micron.
So it's crazy that, last year we were all concerned about there not enough chips to make the products we want. Now, at least on the PC side, we see a glut. Is that the sort of bifurcation here? Is that the difference, that these are for PCs and not for cars?
Yeah, exactly. I think that's the main thing. As you mentioned, we were always talking about how car makers couldn't get their hands on enough chips. And now, that's completely gone, and the story has moved over to the personal devices. And I think that Micron will have a big impact on the industry, given they're such a big supplier, with that 10% reduction, with the reduction in CapEx spending that Ed mentioned. But it won't really be enough to change the supply dynamic unless other companies follow suit. And you'd be looking at companies like Samsung and the really other big firms around the world, not just in the US, to do the similar thing. And that would really adjust that supply situation further. But we could be a way off that happening now, I think.
All right, Joe, thanks very much. Bloomberg's Joe Easton there. We're going to have more on this Micron story and what's going on with the entire chip industry later on in the program. William DeGale, lead portfolio manager for technology at Blue Box Asset Management, will join us. First off, though, I want to take a look at some of the other stocks moving in the pre-market. Of course, Micron is down in early trading today. We see Tesla actually rising this morning. It's offering U.S. consumers $7,500 to take delivery of one of its two cheapest models, the Model 3 or the Model Y, before year end. It's a move likely to foment more debate over the extent of the car makers' struggle with demand, and also brings into question what the U.S. government is going to require in order to give consumers a tax credit for electric cars. Carnival gaining after reporting a narrower than expected quarterly loss per share yesterday. Its CEO, Josh Weinstein, said booking momentum has continued into December. Well, here you see the shares slipping now down a little bit, about 0.25%. Not a lot of volume, as Ed pointed out, ahead of this holiday, ahead of Christmas. Oric Pharmaceuticals shares are surging this morning after the company entered into a clinical development collaboration with Pfizer and agreed to sell 5.4 million of its common shares at a price of $4.65 a piece to Pfizer for proceeds of approximately $25 million. It's a small stock, but you can see it's up almost 50% in the pre-market. Ed?
All right, coming up, Nina Skero, CEO of the Center for Economic and Business Research. Lots on central banks, I'm sure. And German Finance Minister Christian Lindner is betting on Germany's economy. Check out our full exclusive interview online or on the Bloomberg terminal.
I have to ask you this question very briefly, yes or no. What's going to recover faster, the German economy or the German national team? Because the World Cup was not good for you.
The economy.
The economy, wow, that's a strong bet, because you have 2 years until the Euro Cup and you host it right here in this country.
Economy will recover faster.
It is now 135 or something, right? 32 or something. And it will probably slowly, appreciate toward 120. I think it will hold around 120 for some time.
That was Mr. Yen, his real name, Isuki Sakakibara. He sees the yen strengthening to 120 per dollar and expects the Bank of Japan to surprise markets again by tightening monetary policy as soon as next month. The BOJ's recent moves have been some of 2022's most memorable market moments. Our markets reporter, Valerie Teitel, is here to recap. So, Valerie, what will history remember from this year?
The BOJ definitely gave us a lot of them. My favorite one was their October intervention where they shoved dollar-yen down 6 handles in a matter of 45 minutes. Turns out they spent near $40 billion doing that. It was Friday, 3:30. I was at the gym. I nearly fell off the treadmill. That was a big one for me. I don't think I'll forget that soon. The other memorable moment was that week in June where we had a bomb dropped by almost every central bank. Powell had to leak in the Wall Street Journal that they were going to go 75 instead of 50. The ECB had to pull that TPI tool out of the bag to save BTPs. The SMB hiked 50 instead of 25. And the Bank of England, Bailey, came out saying they were going to act forcefully against inflation. It all happened in a matter of 5 days, and it also coincided with the S&P bottoming on that June 16 date. But look, this year is really one for the history books. I'm still out there on the acronym that it appropriately fit this year, because I can say confidently in my lifetime, I don't think I'll ever see central banks hike this quickly, this fast. Nearly every central bank hiked over 250 basis points this year, the one outlier being obviously the Bank of Japan, but they might not be far behind.
So, you know, if you look at this tightening cycle as once in a generation, Valerie, we had something similar for the previous generation or 2 or 3 ago. Obviously, the Volcker tightening cycle is probably still the most infamous in U.S. history. How do you compare the two?
Look, I still think that's yet to be written because we don't actually know the recession we're headed into, the growth slowdown we're headed into. Is history going to look back on this kindly, saying they did the right thing? Or are we going to have a massive hard landing in the U.S. and we might be, scratching our head thinking Powell acted too fast, too soon? It was only a year ago, Matt, that we thought the Fed hiking 50 basis points was a big deal, let alone 4 75 basis point hikes in a row with a near 425 cumulative tightening coming from the Fed. We still have yet to see what the effects for this going to be, and I cannot wait for 2023.
Okay, our markets oracle, Valerie Title. By the way, guys, my 2022 is very different out in San Francisco. You know, you guys don't remember the Meta crash February. You don't remember the retailers anyway. We'll get into it another time. For more market analysis, you can, of course, check out MLive Go on your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Ed Ludlow in London with my good friend, Matt Miller, in New York. Now, keeping you up to date with news from around the world, here's the first word. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning customers away. Months after the city of 25 million endured a brutal lockdown to stop the virus spreading, COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed and public transport usage is plummeting. BHP has made a binding offer to acquire Australian copper producer Oz Minerals for $6.4 billion. The deal is set to consolidate BHP's position as one of the world's largest producers of copper, a metal, of course, used in the clean energy transition. BHP says the bid will now go to shareholders for approval by early April. And H&M has halted sales of its Justin Bieber collection after the singer accused the company of selling clothes depicting him without his consent. The Swedish retailer says it followed all the proper approval procedures, but is pulling the goods, quote, out of respect. In other Bieber news, the singer is said to be near a deal to sell his music rights to an investment entity backed by Blackstone. Bloomberg understands Bieber's stake could fetch around $200 million. And in London, pubs and restaurants say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action is sweeping the UK with walkouts by workers in the Royal Mail, health sector, airports and various parts of the civil service, as well as those by rail and bus staff. More transport disruption is expected over Christmas and into New Year, Matt. It's been a difficult political story this week in the UK, a difficult economic story at a time where the country faces budget issues, but also many of these workers are those that were hardest hit during a tough 2 years with the pandemic.
Right. Well, I mean, I've lived in the UK and I endured many rail strikes. they seem fairly commonplace. But the healthcare strikes, to me, are shocking because a year ago you were all applauding these healthcare workers. That didn't keep them warm or feed them. And now they're asking for a raise, but I guess no can do. Are there people who think healthcare workers are overpaid?
Well, one UK minister accused the ambulance union just 24 hours ago of deliberately putting people at harm. So, you know, it's a tough one.
Wow. All right, very interesting. We'll continue bringing you the top headlines. Nina Skero joins us next, CEO of the Center for Economic and Business Research, to talk rates. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Unwavering support. President Biden pledges to back Ukraine for as long as it takes as President Zelensky presses Congress for more tanks, planes, and cash to defend against Russia. And facing the Fed, Sam Bankman-Fried lands in New York to face criminal charges while two of his top associates plead guilty to fraud in connection with the collapse of FTX. Plus, Micron posts a lackluster revenue outlook for the current period, indicating the slump in demand for computer components will persist into 2023. I'm Matt Miller in New York with Ed Ludlow in London. Anna Edwards and Kaylee Lyons are off today. And Ed, it was a big rally yesterday for risk assets. Today, there's not a heck of a lot going on in terms of U.S. futures. We're looking at a drop of about 0.1% to 39.02 on futures. You know, a week ago, we were up above 4,000, so we've come down considerably from there. But we do have investors buying the 10-year bond. That pushes yields down now 2 basis points to 364. They're also buying NYMEX crude. That pushes oil, at least West Texas Intermediate, up to almost $80 a barrel at 79.60. It's been a very volatile month for oil, up to almost 90, down to about 70. It hasn't been that volatile for Bitcoin. Since the November 7th collapse of FTX, Bitcoin dropped to about $16,000 and has held there. It's gone down below that and up above 17, but basically hanging around this level for over a month now, a month and a half. 16,838 is the level there. As we continue to get news on FTX, it doesn't seem to impact the underlying, well, the OG of the cryptocurrencies, at least. We've got a lot of pre-market movers today. One is Tesla. Those shares actually gaining about 0.5% as news comes out that U.S. consumers are going to get $7,500 off of either the Model 3 or the Model Y. I guess you could have $7,500 off both if you order them both, as long as it's before year end. You only have a few days. December 31st is when this deal supposedly runs out. It's likely to cause more debate over the extent of the car makers' trouble with demand and put pressure on U.S. authorities to give us details about what we're going to need to get a $7,500 tax rebate, which is a separate rebate for electric cars. By the way, cruises, Carnival is down about 1/3%, even though Carnival reported a narrower than expected quarterly loss per share yesterday. The CEO, Josh Weinstein, said booking momentum has continued into December. Nonetheless, at least in the pre-market, those shares are off. Pharmaceuticals. If you've never heard of it, well, you're paying attention now because it's up almost 50% on the session in the pre-market after the company entered into a clinical development collaboration with Pfizer. It agreed to sell Pfizer 5.4 million of its common shares at $465 apiece. You can see it's trading at $439 right now for proceeds of approximately $25 million in total. So not a huge stock, nonetheless getting a big boost here in the U.S. pre-market. Ed, what do you see in Europe? What are the open markets telling us about this session?
We've had a bit of a change of direction in the last few minutes, actually. You can see now that the Stoxx Europe 600 basically flat, having been higher, consumer discretionary, a little lower, acting a drag, but actually tech, the biggest laggard in terms of the sectors. You look at semiconductors in particular. This is a basket of the 4 main European semiconductors, including ASML, down by a percentage point. Probably because of Micron's warning about cutting capex. Those names in Europe are particularly focused on chip-making equipment, and if Micron's cutting capex, they're unlikely going to be investing in new equipment from some of those European names. There's a little more energy in bond markets here in Europe than perhaps we had 24 hours ago when everyone was kind of taking a time out in reaction to that hawkish tilt by the BOJ. A lot of commentary out there, Matt, on the Bloomberg terminal. I don't know if you've seen the comments from Louis de Guindos of the ECB saying actually 50 basis point increments going forward. That's likely. Of course, we've zeroed in on what's happening with the Fed. I would say there was a kind of energy and euphoria around that US consumer confidence data out of the US Wednesday coming in at 8-month high. But looking at the bond market, I suppose we're kind of treading water, thin volumes, particularly in equity markets. It is Thursday, Friday, and then you have Christmas over the weekend. So if you're at your desk and working, watching the show, reach out, say hello to us. But I don't think many of you are right now.
Yeah, it's a very good point, Ed, and I appreciate you bringing us back to that, because the consumer confidence news really flies in the face of a lot of other stories that we're hearing, anecdotal stories about layoffs, data points that we're seeing in terms of inflation. Yes, it's coming off, but it's still incredibly high. So it begs the question, why are consumers becoming more confident? Joining us now to talk about that, as well as obviously all of the central bank news that Ed just mentioned, and the BOJ, of course, is Nina Skero. She is CEO of the Center for Economic and Business Research. Nina, talk to us about the state of the U.S. economy first. It's obviously hugely important to global growth. Why are consumers here more confident, even as the Fed hikes into what most people expect to be a recession?
You're right that the U.S. is very likely heading into a recession, but it does seem now like that recession is going to be relatively brief and relatively shallow. So we could either see sort of a, not quite a recession, but an economic downturn, or if we see a recession, it's said to be relatively short, relatively mild. As you say, sort of there is this comparative element to how is that downturn in the U.S. going to compare to what we're seeing here in the U.K. or across Europe. There are certainly a lot more downside risks on this side of the Atlantic relating to the Ukraine situation, to energy prices, to the fact that central banks are a little bit further behind in their hiking cycle and probably have a little bit further to go. But it seems that the news out of the U.S. is we're by no means out of the woods. Things will get worse before they get better, but there is a light at the end of the tunnel.
You mentioned the UK, and we got some disappointing GDP news out of Britain today. At the same time, Ed tells us the government doesn't even have enough money to give poor healthcare workers a raise. How bad is it?
It's a difficult situation in the UK. We're definitely going to see recessionary conditions, certainly in the first half of 2023. And in fact, the UK is, of course, we're still waiting for more data, and there will be revisions to GDP data, but we're probably already in a recession, or at least on the brink of one. And you're right, there's already been so much attention on the UK's fiscal position in recent months following the mini budget. There are now new questions arising given the extent and the prevalence of strikes across healthcare, rail, Royal Mail. I mean, pretty much any sector you can name that has a union in the UK is on strike or about to go on strike. So there are new downside risks emerging and questions around, is the government going to have to reconsider what they've committed to meet those wage demands?
Let's consider some global downside risks. Talk about China. It's interesting. President Xi seems to be balancing this equation where an economic reopening will offset what appears to be very challenging circumstances with the spread of COVID-19. What's your assessment of China, not just for their own economy domestically, but the feed through to the global economy as well?
Earlier in the year, we were looking at China and saying that our guess is that after party conferences had passed, what we would see is sort of a quiet, gradual reopening. Given the rhetoric that they've had since the beginning of the pandemic, we weren't expecting, this big blockbuster news of, okay, that approach was overly conscious, we were wrong, we're opening. But we were expecting this sort of slow, quarantine is being cut, this gradual reopening, and that is exactly what we have seen. Now, what is happening at the moment is that is overlapping with quite an unfavorable health picture in China. And because China is sort of on its own health cycle, let's say, given the issues they've had around getting vaccination rates up, given rising hospital admissions, the problem is now that this economic reopening and travel reopening is overlapping with a worsening health picture, which could mean a new sort of global wave, certainly not to the extent we've seen in the past, but we could see rising cases as a result of China reopening when they're having having COVID issues.
Bloomberg broke what appears to be a very important story this morning. China to cut quarantine for overseas travelers from next month, according to sources. I guess my question is how stimulating is a successful economic reopening in China for the rest of the world? I remember sitting in this chair, and how often do we say that China is the engine room of the global economy? Are we going to get back towards where that is the truth once again?
I think we are, probably not to the same extent, partially because changes that have happened over the recent years and the sort of the supply chain disruptions, some of them are going to persist. And I would say they have probably made China a little bit less important in the global landscape. But I mean, given its size in the global economy, we're looking at this transition away from China being such a focal point, taking, probably still close to a decade or anything rather than anything more immediate.
Nina, let me get to the BOJ and ask you what you expect after the moves that we had, the market had been pushing for, and it looks like the dam is finally breaking. What's next?
Certainly, BOJ has been an interesting story throughout all of the year. It really sort of, dancing to the beat of its own drum, I would say. I would say that I can't comment in detail on what we're expecting from the Bank of Japan, but certainly in terms of the Western central banks, we're expecting continued hiking, but that cycle coming close to an end. But in terms of what's happening in Asia, it's a very different situation and a lot harder to predict given what we've seen in the past year.
Still, in a sense, the big outlier. Nina, thanks so much for joining us this morning. Nina Skero there of the Center for Economic and Business Research. Coming up, we're going to talk about chip makers because Micron's results came in worse than expected. We'll discuss the future of the chip sector next and talk about the bifurcation in microchips. Do we have enough for cars, but way too many for PCs? What's the deal? We'll tell you next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Nathan Sheets, Global Chief Economist at Citigroup. That's at noon New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Ed Ludlow in London with Matt Miller, who is in New York. Now, Micron says it will cut headcount by about 10% in the coming year as it projects a wider than expected loss in the current quarter. The Micron miss comes as the chip industry battles plummeting demand, in part. Joining us now is William DeGale, lead portfolio manager for technology at Blue Box Asset Management. You invest in and cover the chip sector broadly. I don't believe you hold Micron shares. This is a company that kind of pre-warned us in November, right? They already cut production on the DRAM side. They kind of guided us that things would be worse, and then things got even worse. Why is that? What did they get wrong in the short term?
Well, I think this is actually their fourth miss of the year, so not just two, but I think four, and they've been cutting capex for a while. I'm not sure they got anything wrong, just Micron's in a very, very difficult market. Computer memory, whether DRAM or NAND, is essentially a commodity. There was one very, very strong player, Samsung, and if you're up against Samsung, life is extremely difficult. And also, it was a sector that saw no particular shortage. So there was no real shortage of memory that I'm aware of as a result of COVID. And now there's a slowdown in demand. Clearly, we are entering some sort of recession, generally in most developed economies. And if you have a slowdown in demand, then people don't need as much memory chip. It's a very easy thing to cut. So you can spec your computer tomorrow and just put less memory in it. And that's immediately a loss of sales for the memory maker. So it's very susceptible to economic fluctuations. It's very much consumer facing. It's very short term. It's a difficult business.
Right. Miller's going to want to ask some pretty granular questions about the end use cases for some of these DRAM chips and other chips. What I want to ask you, we started this year, those of us that cover the chip sector closely, being promised multiple years of expansion, that the boom and bust cycles of eras past wasn't going to play out this time. But that's exactly what's happened. So why were we wrong at the beginning of the year?
So I think you've got to realize that the semiconductor industry is not one sort of homogeneous whole. It's made up of various very, very different elements. And at one end, you've got the extreme commodity leading edge memory market, which is an absolute nightmare to market to operate in. And the other end, you've got the trailing edge, where you have things like microcontrollers and analog and sensors being made on pretty elderly equipment, because it's actually very difficult to shrink these components. They're very sophisticated, but you can't make them on the leading edge equipment. You make them on equipment that was, new in the 1990s. Demand for that trailing edge has been building slowly, steadily, and quietly for the last 20 years. And capacity is completely limited. No one's been building 1990s capacity since the 1990s, and it's simply run out. There's no more. All the second-hand equipment has been used up. All the old fabs are in use, and using new equipment, building greenfield for this stuff, just completely changes the economics. And so I think COVID just pushed this problem that was growing steadily right over the edge and created a really dramatic shortage, and that's still there. So there is still a serious shortage of trailing edge semiconductors, and it's going to be very difficult to fill that. So I think investors are focusing the wrong end. They're looking at the leading edge, which is very difficult, and they should be focusing on the trailing edge, which is where real money is being made and where the economics are changing in a very favorable manner at the moment.
Well, and it's such a diverse industry. It's such a diverse book of goods, right? Because I don't really care about DRAM at all. It's a commodity that's going to have boom and busts, and it's pretty much fungible. What I do care about are the chips. 3,000 chips are used in a modern car. When Claudio Domenicali builds a Ducati Multistrada, he needs a lot more chips than even the CEO knew he needed, 2 years ago. These are the chips that matter, and I can't understand why companies that make these aren't doing so much better. If I look at the SOX Semiconductor Index, every single company on that index is down year to date. Why doesn't the market differentiate as much as it could?
Well, so the stocks that are most focused on the trailing edge, sort of analog devices, text instruments, and so on, they aren't down anything like as much as the leading edge play. So that is the market is differentiating. It's probably not differentiating enough. And if you are building a very sophisticated vehicle, the chip that you're short of is probably not the highly sophisticated central processing unit. It's probably a number of pretty cheap and cheerful microcontrollers or analog chips, which only cost a few cents normally, and might well now be changing hands for tens, even hundreds of dollars, because they're just so scarce. I've been talking to lots of managements of US companies in the last few weeks, and they're all talking about the golden screw. And the golden screw, the bit they just can't get hold of, is often a comparatively cheap device, but it's just very, very scarce at present.
All right, William, it's great to hear about the differentiation here. I think we could do an hour-long program on all of the different kinds of chips. Is there one statement you could make about the whole industry as we head into 2023? Is there one position that you want to take on chips for next year?
So the last Micron pre-announcements, the third one, they took half of their capex spend off from wafer fabrication equipment, so the equipment to make these things. That knocked about $4 billion off maybe the annual spend on that equipment. And 5 days later, they announced a completely new project for $100 billion for a new fab complex in New York State. And people are focusing on the $4 billion loss, and they're ignoring the $100 billion gain. And it's not just Micron, it's Samsung, it's TSMC, it's Intel. It's Texas Instruments. They're all building completely new greenfield over the next 5 to 10 years, and that's an enormous driver for semiconductor equipment. So just ignore the cycle.
Well, William, really quickly, let me jump in here. Let me jump in here really quick, because I think I'm right in saying you do hold TSMC in your funds, right? And that's what I'm asking you. These are names that are pledging to invest and build in multiple jurisdictions. Is that what attracts you to them?
Yes, well, TSMC is just an incredibly important company, becoming increasingly important over time. There isn't anyone like it. It has a uniquely good way of dealing with multiple customers as a foundry, so supplying chips to companies that have designed them. And there's no one really can keep up with that. And also, at the moment, they have a technology edge. So they're in a very, very strong position indeed. And they're cyclical. All of these stocks are cyclical, but they are growth cyclical. And some of them have got very, very strong growth profiles. So I would ignore the memory market because it's a very difficult market to get right, and it's not massively value creative. And I would focus on the much longer term, more solid stories, which are just going to cruise through this. They'll have a weak year, and then they'll go back to their trend again. And that trend is very, very good indeed.
All right, great to get your intelligence, William. Appreciate you coming on the show. William DeGale there of Blue Box Asset Management talking to us about the chip sector. Coming up, we're going to run you through some of the key events that are coming up today as we get closer and closer to Christmas. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Ed Ludlow in London. Let's take a look at what's ahead today as we approach the Christmas holiday. At 6 a.m. Eastern, we will get the Turkish rate decision, expecting a hold at 9%. President Erdogan pinning the success of his re-election on low rates. And as we learned about an hour ago, also a 55% increase in minimum wage. At 8:30 a.m., we get an initial jobless claims number and the third print of third quarter GDP in the U.S. Unless there's a serious revision, probably no reaction there. Later on, we're waiting to hear more from Sam Bankman-Fried or his attorneys. His top two associates, they pled guilty to fraud and are cooperating with U.S. prosecutors leading the FTX case. So Gary Wang and Caroline Ellison are going to turn state's evidence, essentially. And I think this is incredibly interesting because we hadn't heard almost anything about them for the past 5 or 6 weeks. And all of a sudden, they are going to be key witnesses, it seems, in a multi-count case against Sam Bankman-Fried.
And it's also the relationship between them. Gary Wang they met at math camp. They were roommates at MIT. They started these businesses together. We've been moving towards the extradition to the US for days. But this overnight, this was a surprise. This is big.
Yeah, I mean, you know as well as I do that when you make friends at math camp, that's a friend for life. But in this case, that friendship looks like it'll be cut short. The same is true of Caroline Ellison. They were romantically involved, apparently, and nonetheless, at least according to SBF, didn't really share details about what she was doing running his investment firm, Alameda, while he was running the exchange that was giving Alameda like $8 billion in margin. So it'll be very interesting indeed. Really a situation not to make light of because so many people lost money and some people may spend a long, long time in prison. Ed, I know you've got to get off camera and go cover earnings for Bloomberg. That's it for Early Edition. Bloomberg Surveillance, the OG, is up next. We'll hear from Peter Hooper at Deutsche Bank. This is Bloomberg.